Welcome to a new video of the Merchants News. Today we are going to discuss the possible 330 billion merge between two big oil companies. Before jumping in the story, please do not forget to subscribe to my channel. In the heart of Europe, two energy titans are contemplating a move that would shake the world. Shell and BP, household names that have powered civilization for over a century, are considering a merger that would create the largest oil deal in 2 decades. The numbers are staggering: $330 billion in combined market value. But this isn't just about money. It's about survival in an industry facing its greatest transformation since the dawn of the oil age. The energy world is at a crossroads. Oil prices swing wildly, governments demand cleaner alternatives, and billions of investment dollars chase wind and solar projects. In this chaos, scale isn't just an advantage, it's a necessity for survival. Combined, Shell and BP would control 8% of global oil and gas production. That's more influence over energy flows than some entire nations possess. Their operations span from the deep waters of the Gulf of Mexico to the lucrative fields of the North Sea and burgeoning projects across Africa and Latin America. But the real prize is liquefied natural gas. Shell already dominates LNG trading globally. Adding BP's assets would create an unprecedented powerhouse in the fuel that's bridging the gap between coal and renewables. LNG is the golden ticket. Countries are desperate to move away from coal, but aren't ready for full renewables. The financial logic is compelling. Analysts project annual synergies worth $4 to $6 billion, money saved by eliminating duplicate operations, optimizing overlapping assets, and consolidating their vast global trading networks. In an industry where margins matter, these savings translate directly to competitive advantage. We've seen this movie before. In 1999, Exxon and Mobil merged in an $81 billion deal that created the world's largest oil company. The promise was simple. Bigger meant better, stronger, more profitable. They were right. ExxonMobil has weathered every crisis since, from 9/11 to the 2008 financial crash to the COVID pandemic. Scale provided resilience that smaller companies couldn't match, but the road wasn't smooth. Regulators forced the sale of thousands of gas stations and entire refineries. The Federal Trade Commission's message was clear. You can get bigger, but not without paying a steep price. Any Shell-BP merger would face similar scrutiny in the US, UK, and European Union. But there's a critical difference. BP carries baggage that Exxon and Mobil never had. Deepwater Horizon isn't just history. It's an ongoing $65 billion liability that continues to generate lawsuits and settlements. Shell would be inheriting this burden. Today's energy merger isn't about consolidating strength in the old world. It's about marshaling resources to survive in the new one. The energy transition is accelerating, and it requires unprecedented investment. A combined Shell BP plans to invest $100 billion in clean energy by 2030. That's more than most countries spend on their entire energy infrastructure. The irony is striking. Oil giants using oil profits to build the very technologies that will replace oil. The immediate impact would be felt in trading rooms across the globe. A merged entity would have unprecedented market intelligence, knowing production, demand, and pricing across vast networks. When one company controls that much information and that many assets, they don't just participate in markets, they can move them. Regulatory hurdles would be immense. Antitrust authorities would demand massive asset sales, particularly in the North Sea where both companies have overlapping operations. But these forced divestments would create opportunities for smaller companies and national oil companies to acquire premium assets. A Shell-BP mega-merger wouldn't happen in isolation. It would trigger a new wave of consolidation as every other player scrambles to maintain relevance. The industry is already watching nervously, knowing that staying competitive might require finding their own dance partners. Chevron and ExxonMobil would face immediate pressure to respond. European companies like TotalEnergies and Eni might seek shelter in their own alliances. Mid-sized companies that seemed stable yesterday could become acquisition targets tomorrow. The entire competitive landscape could be redrawn within a decade. Banks and trading partners would need to completely recalibrate their risk models. Having one counterparty represent such a massive share of global energy trade changes everything. Credit exposures would need to be reassessed and trading limits restructured. The merged entity would control nearly 8% of global production, dominate LNG trading, and influence pricing across multiple continents. That's the kind of market power that regulators fear and competitors respect. So will it happen? The forces pushing toward this mega merger are powerful. Market volatility demands scale. The energy transition requires massive capital, and shareholders demand efficiency. But the obstacles are equally formidable. The strategic logic is undeniable, but executing a deal this complex, with this much regulatory scrutiny and cultural integration required, would test even the most experienced management teams. Two proud companies with distinct cultures would need to become one. Even if approved, the process could take years. Regulatory reviews in multiple jurisdictions, forced asset sales worth tens of billions, and the complex task of integrating two massive organizations, all while managing day-to-day operations in a volatile market. The stakes couldn't be higher. A successful merger can create a European energy champion capable of leading the global transition to clean energy. A failed attempt could leave both companies weakened and vulnerable to other predators or market downturns. The energy transition is accelerating whether this merger happens or not. Electric vehicles are displacing oil demand. Renewable energy costs are plummeting. Climate policies are tightening globally. The question isn't whether the industry will change. It's who will control that change. For Shell and BP, the $330 billion question may determine not just their individual fates, but the future structure of global energy itself. In an industry built on bold bets and massive risks, this could be the biggest gamble of all. The dance of these energy titans is far from over, and the outcome will shape how the world powers itself for decades to come. Thank you for watching this video, and see you in the next one.